Hello, welcome to another live stream of Master Investor. Glad to be here again on another valuable video on money, business, and investing. Welcome to our community. If you're new, make sure you subscribe to the channel. Today's theme is going to be on what is a personal financial statement. We're doing a 30-day challenge. Okay, we've been doing this for the past week. We're going to continue the entire year so that we deliver high quality financial education, because we want to have business integrity. Remember, when we build a brand, we're not just building a business, a commodity. We need to protect our niche. Whatever brand you're thinking about creating or acquiring, you need to understand, is that brand is protected? Is it a protected niche? Does it have a trademark? Because it has intrinsic value when it does have a trademark. We need to understand how important it is to spot business integrity, because that means the business is complete, is whole, meaning that it's delivering on its mission and is using systems to complete the mission on autopilot, because an asset is supposed to create passive income for us. Unless it's not an asset, if it's not creating passive income or capital gains income, even while we're sleeping, then it is not an asset. Know the difference between an asset and liability. So the liability takes money away from our pocket and is labeled as liability on a liability column in our personal financial statement. And as much a business or an investment, they also have a financial statement, and in there we can see the liabilities of that business, the assets, the income, the expenses, and the cash flow statement. We're going to be speaking about the 6 different important words that we find on our personal financial statement, which are income, number 1. Number 2 is expenses. Number 3 is assets. Number 4, liabilities. Number 5, cash. And number 6, flow. We're going to learn why it's so important to understand, to read financial statements when we are wanting to build true wealth. It's the only way, because that is fundamental investing. And the way we want to invest is by controlling the assets ourselves. We don't want to necessarily give our money away to anyone to invest it for us. We want to make sure that we're making those decisions on our own and controlling our finances by having assets on their company, or more than one company, because we could have different assets in different asset classes. So we protect ourselves with companies. We do everything with entities, legal entities, and we suggest you to read our ebook, How to Build Cash Flow with the Internet, Turn Passive Income On. Link in the description. Go to our website, download and enroll into that digital course, because it will come with the ebook, which has more than 500 pages of financial literacy, 49 chapters. It has a glossary of money at the end, and also you'll find bonuses that will come within that digital course, which are assets for you to build wealth. So download the financial statement that is found on that digital course, How to Build Cash Flow with the Internet. You can put it into Excel and then fill it in, because it's going to help you literally understand where we are financially today. You're going to know how we make the money, right? How do you make money today? What is your source of income? Do you have a job? Do you have a side hustle? Are you self-employed? Remember, being self-employed is not the same as being an entrepreneur. An entrepreneur controls systems that are doing the selling and telling for us, even while we're sleeping, and it's creating positive cash flow because it's solving a problem in the marketplace without us having to be in the middle of the transaction. A self-employed is the system. That person goes out and has to work to earn the money. So it could be a doctor, a lawyer that has to see their clients every day in order for them to create income. And remember, those players are on the left side of the cash flow circle. The cash flow circle has 4 different players. On the left side, you have the employee, the self-employed. On the right side of the cash flow circle, we have the business owner and the inside investor. In order to build true wealth, we have to play on the right side. And yes, anyone that's playing on the left side can make a shift by first changing the mindset to the wealthy one. We first have to change in here. We have to have a list of goals that are catered to building our first asset, to put a business together, to create a brand, not just a business, because otherwise it's a commodity. And it will be hard to raise capital when it comes to commodities or true brands or real companies that can be expendable among the world, among the different countries, like Coca-Cola, like Amazon, right? We can serve the masses. What type of product, what type of solution we want to provide to the world, and what type of problems are we seeking to solve on a daily basis. Remember, once we build the first asset, then we need to move to do the second asset, whether it's investing into an existing asset that is already bringing in positive cash flow because it's solving a problem. It could be a commercial real estate property, it could be an apartment building, right? It could be a business that it has been making money for the past decades. And all we're doing is taking over, we're acquiring from the existing owner, from the seller, and we're going to improve the asset because we have spot different mismanagement points in the asset, okay? Because we're going to be able to tell through the financial statement. The financial statement will tell us the real story about any type of business or investment, and also ourselves. That's why we need to start with a personal financial statement. Okay, we're also going to recap on the different levels of investors and the different categories of investors. There are 5 of each, and we're going to go over them because it's important. That's what we talked about this past week, but we're going to stress it because we need to get you on the right mindset. If you're watching this for the first time, in order to build wealth, if you're interested in building wealth, you need to rub shoulders with people that are wealthy. You need to listen to people that are wealthy. You need to figure out what type of formulas they're using in order to become wealthy and work less but make more in the form of passive income and capital gains income. We focus on building assets on our asset column that will create positive cash flow. That's the holy grail to get to infinite return on investment. And what was infinite return on investment? You may ask if it's the first time hearing the term. Infinite return on investment is when we have no money into the deal, but we still collect passive income from it. It creates and generates passive income into our pocket. So we have control over the asset. If there's any good debt into the asset, if we raise capital because we finance the entire deal, then that has infinite return on investment because we have no money in the deal. Or if we put any money down, we have recouped the entire capital invested back that we initially put down to obtain the asset. So we need to understand how not only recoup the entire investment back, how to measure it, our return on investment. And we always have to measure it based on passive income, because otherwise it's not based on, if we don't do it through passive income, you'll be basing your return on investment on opinions, and you want to stay away from that because it's riskier to go based on opinions than facts. Facts, you'll be able to say, okay, this will bring me this much back every single month. So in less than a year, I'll be able to recoup my initial capital invested back. And then from there, we have infinite return on investment because we still control the asset. We recoup the entire capital back that we initially invested, and we still control the debt of the bank, which we use to acquire the asset. And every time that payment gets made to the bank, right, on the amortization payment schedule that they give us, and we're making a payment to them, whatever is left over is our positive cash flow. So that debt is considered good debt because it makes us wealthy, makes us passive income. It's making the banks money, is making them income, and also making us income by just managing that debt, by putting it to work, because the banks are in the business of lending money. So once we know how to read financial statements, the main reason why is the most important thing to do when it comes to building wealth, because now we can raise capital. And that's the job number 1 of an entrepreneur. Once we have financial statements from a business or a real estate property or any type of investment that is creating cash flow, then we can show the bank, approach them and say, hey, this is a great deal. This will be extraordinary on your books because it's making this much cash flow per year. This is how much is making per month. This is how much is revenue per week. These are the liabilities. These are how we're going to improve it, how we're going to add value, how we're going to raise the rent. Here is the financial statements. Here are the taxes for the past 10 years. Here's the cash flow analysis. The bank looks at that. That's what they want to see, because they will get all the information that they need in order for them to make a decision to lend us the money that we're seeking, which sometimes is even 100% of the deal. A lot of times bank will give 90%, 80%, depends on the relationship of which type of bank we approach. But however, we want to always focus in raising capital and raising money, going to the banks, going approaching other people, because we have deals that are sound. It makes sense. And remember, when it's a good deal, the numbers work. And when there is a bad deal, the numbers do not work. It's that simple at the end. You have to crunch the numbers. You have to be able to read the financial statement and say whether this is a true asset or is not an asset. Know the difference between opinions and facts. When we are measuring a return on investment on any investment that we make, then we need to base it on passive income instead of capital gains income. Why? Because it's based on facts. We want to go with the facts. How much has it made the past 10 years? How much has it made the past week? How much is it making per day? How much cash flow is going to create for me, right? Am I going to have enough passive income at the end of the month to pay for the debt service and to pay any other investor that put money down, right? And then from there, we're going to go and add more value into the asset, raise more capital, use OPM, other people's money, the bank's money, other people, private lenders, because they're looking for opportunities because they don't have the time to look for the other opportunities. And as much the banks cannot obtain an asset themselves and make money with it, they need to have somebody in between. And so that's when we come in, the inside investor. And we need to be the inside investor because we want to be as close as we can to the deal, if not the closest to the deal, because we created the deal and we have the insider information. That means that we are getting the most out of All right, I think it's been a while since. Let me see. I have to check because my battery ran low and I didn't know, and so I don't know how long I have been talking for without a audio. Let me check on here real quick. Otherwise, I have to stop this and restart because I don't know. I could have been the entire time, and that is okay. We'll do it again. Okay. We don't mind that. Okay. Let me see. I have it right here. You need to figure out what type of form. Okay. Oh yeah, 5 minutes. Okay. All right. All right. We're gonna start over again. See you on the next live stream. Stay tuned.